Welcome to Securities Lending Saturday. I'm Roy Zimmerhansl. I'm your host. And today we're going to be talking about a comparison between repo and securities lending. So if you are in the world of securities finance, whether you're a lender, a borrower, an intermediary, a service provider, or you're just plain interested, then this is the place for you. So let's get started. Hello, everyone, and welcome back to another Securities Lending Saturday. This is show number 40. Yes, we've done 40 of these episodes in a little bit less than a year. So I'm quite excited about joining you again on a beautiful Saturday. It's been a great weather week. That always puts me in a better mood, and I'm in a great mood today to be here with you. I want to welcome you to another Securities Lending Saturday. I hope you're having a great Saturday so far, whether you are in Asia and it's already afternoon, or in fact, late afternoon and early evening, or if you are in Europe and we're just around lunchtime, or you are in North America and it's morning time, morning coffee time. Anyway, as I always have a slide deck, which you will have seen flash up a couple of times already, because I still don't have a producer, but someday that's my dream, is to have someone be a producer and make this show a little bit more professional. Anyway, now let's get to the slide deck. Here we go. We're comparing repos and securities lending. So let's get to it. This is what we've been talking about in the previous 39 weeks. Today, securities lending versus repo. Next week, I'm going to take a look at the latest ISLA market report. They've been producing these reports for a number of years. It's the 16th edition. It came out this week, which takes data up until the end of December 2021. I'm going to do a review of that. There's some interesting information in there that I want to share with you and give you my perspective on it. So that's what we'll be doing next week. This week, securities lending versus repo, or repos versus securities lending. So this is what we're going to talk about. This is a two-horse race between the two. We'll do a compare and contrast. So we'll talk about what the definitions are, what the primary objective is, who the users are. We'll talk a little bit about collateral, fees, and the typical tenor. So don't forget, this is the YouTube channel where you actually be able to see this and about 109 other videos that I've done over the past couple of years. So have a look there. As always, you can get the slides from the series by signing up to this spot and SL Fundamentals, bit.ly/SL Fundamentals, and you would get sent this slide deck and previous ones. So don't forget to sign up if you're interested in that. And now let me make some space for this stuff so we can actually see what's on the slides. Right, that's what we're going to be talking about. Let's get to it. Of course, before we get to it, a word from our sponsors, me. Listen, I really appreciate it. We went over 500 subscribers recently. That's enabled the community channel. That's been fantastic news. I've been really happy about that. I post every day something on the community channel, and I'm wondering if I can just quickly bring that up. Let me see if I can do that. Let me get rid of that one and move another slide around. Here we go. Almost there. And now if I bring it back up, you'll be able to see, that's right, the community page. So if you go to YouTube and you just click on my name there, you'll see the community one today. As I mentioned, I put a link in there to the ISLA report, so you can have a read of it on your own rather than wait till next weekend or wait until the video, or read it and ask questions. If you have questions or comments, I really want you to put stuff in. As yesterday, I posted that I was going to be talking about a comparison of securities lending and repo. Again, in future, if you have ideas on videos you'd like to see, or thoughts, questions, whatever, please put them in here. But there's all kinds of things in there. Put in an occasional poll to find out what you're doing. But also, this is the original one, the first launch. But use this to raise questions, make comments, make suggestions. Okay. So let me stop sharing that, get back to the slide deck, And what we'll do is we'll get to the show. So what I want you to do is, if you think this is valuable to you or any of the other videos, please give us a thumbs up or a like on whatever platform you're looking at. I know a lot of people have been sharing the channel with their friends, so we've had quite a good drive for subscription growth. We're over 500 comfortably now, and thank you so much for that. I've been quite excited about having the opportunity to share this with a broader community. All right. First of all, let's talk about the definitions. So repos is obviously a shortened version of the phrase sale and repurchase agreement, because that's really what it is. It's a sale of securities for cash, while at the same time making a commitment to buy those securities back or sell those securities back, depending on which side of the transaction you're on, at a future date at a fixed price. And although the legal title of the asset being sold is transferred because it's a sale, the seller, of course, contractually keeps the economic benefits, the market risk of holding that instrument, because, of course, they're buying it back in future. So it is going to be theirs once again. And of course, whoever is receiving the cash, because it's really about borrowing or lending cash. Repo transactions is not true of 100% of the trades, but the majority of the volume and value outstanding is a secured loan from one party to another party, and that security is the security's collateral. Okay. And the borrower of cash, just if you were taking a cash loan or borrowing money from a friend, you would pay an interest rate. In this case, it's called a repo rate, and that's the interest you're paying for borrowing that money on a secured basis. So you would expect, since you're providing security, that it's a lower risk transaction for your counterparty, and they would be taking a lower interest rate because of that. Conceptually, that's true. That's not always true. Sometimes you can get cheaper unsecured cash in this crazy, wacky world we live in. But generally, it's a safe, secure cash loan backed by and supported by collateral. And securities lending, again, securities lending is a temporary transaction, and it's a transfer of stocks or bonds, and it's done in exchange for a fee. Now, usually the borrower is providing collateral. That's almost always, so usually maybe it doesn't capture just how overwhelmingly collateralized it is. There are exceptions, though, where there's still uncollateralized lending going on, but that's very much a de minimis activity. And again, similarly, legal title transfers, but the seller or the lender of that asset, the original investor who had that asset, continues to have the economic performance of that asset. So it's both the benefits and the risks. Okay. The only thing that they're giving up, of course, is for an equity that's on loan, they're giving up the right to vote. Okay. So general definitions for the two. The objective, just touching back on that, the goal for doing these sorts of trades is that primarily, repo really is a transaction structure that's designed to facilitate a short-term secured borrowing or lending of cash, as it says here. So you have two parties, one that has cash, one that needs cash, and the securities move as collateral. And the collateral that's provided by the borrower, generally speaking, is fungible with similar assets. So one AA government bond will be similar to another AA government bond. One corporate bond that's rated single A will be similar to another corporate bond rated single A that has a similar tenor or maturity profile, similar interest rate, similar type of issuer, maybe in the same segment. So you're looking for assets that are interchangeable as collateral, because all the cash lender wants is something of a certain degree of quality that says, if my counterparty fails to give me back my cash, that's okay. I've got these securities and I feel comfortable that I'll either keep them as an owner or more likely be able to sell them in the market and recoup the cash that I have. Now, securities lending, the difference there is, while the asset that's in demand in a repo is usually about cash, somebody has cash, somebody wants cash, and the entity that wants the cash, that's the driver for the trade. For securities lending, though, it's the kind of the opposite end of the transaction. There is a specific security, a stock or a bond, that a borrower wants to target. They want that specific stock. They want General Motors stock, not Ford stock. They want Apple shares, not Microsoft shares. They aren't interchangeable. So once they have obtained that asset from the other entity, they, of course, are also providing collateral, but not general collateral in the same way that it's used in repo. I hate the fact that general collateral is used in securities lending to mean something a little bit different, which means more sort of blue chip, very liquid, low priced stock, like low fees for lending it or borrowing it. So the collateral, though, is fungible. So they'll have a collateral profile that says, in exchange for lending you this security, I'll take any collateral that looks like this. Maybe main index equities, maybe it's government bonds, maybe it's highly rated corporate bonds, maybe it's cash. But whatever it is, there will be, it won't just be one type of or one specific asset they'll take as collateral. They will take a group of assets as collateral, and those will largely be fungible between them. Okay. You might have different margins for different types of assets, but nevertheless, you can give this type, that type, or the other type, depending on what the lender is willing to accept. So repo, it's all about the cash. Securities lending, it's all about the stock or bond that's in demand. That's your fundamental difference. The users and participants. So this is a pretty broad community, and it's getting bigger as time goes on. So let's look first at repo trades. For repo trades, you have the cash-rich investors. So look at mutual funds and insurance companies, entities that get cash flows in. They need to invest them and deploy them, and sometimes they have inflows that they need to place cash while they're trying to decide where they're going to place the money. So they have short-term funds available, and they want to lend those out in the market, or they have proceeds from sales or any number of different things. The reality is they have cash. They're trying to get an extra return rather than leave it in the bank as a deposit. And they want to do that safely and securely. And so they'll do a repo trade, and they're placing their cash in the market. And the people they're placing them with are inventory financiers. So what I mean is banks, hedge funds, really any sort of institution that has gone out and purchased an asset, and now it's sitting idle on their books. What they want to do, these sorts of entities that are generally trying to get investment returns, that's their target. They're trying to reduce the cost of holding that inventory or generate incremental returns. So what they're trying to do now is say, I've got an asset, I've spent money to buy that asset. Now, can I finance that, get the cash in, and redeploy that cash into another successful strategy that will drive up my return? So people with cash, people with securities that need to finance them, they come together. There's also infrastructure and intermediaries. So what I mean by that is central counterparties, who are really the clearers and the risk managers for many types of securities and derivative contracts. They end up taking collateral from their members, and a big proportion of that collateral that they take is cash. And again, what they're looking for is a deep, liquid, secure way of deploying that cash to keep it secure in the event of a counterparty default, but also to generate incremental returns. So CCPs are very big players. And securities lenders, again, if they are lending securities against cash collateral, they now have to do something with that cash. Repos are a safe outlet to generate incremental returns. So they are big players in the market as well. Now, central banks, clearly, they are fundamental players in the repo market. And in many ways, they are the lenders of last resort. They're the counterparty of last resort with financial entities in their own country. So they'll often have specific facilities for those entities, but they also get engaged to influence the supply of money in the market. So there's cash in the market. If they think liquidity conditions are getting tight, what they might do is they might do repo trades. They might reverse in bonds, put more cash into the market. So the counterparties that they give the cash to, they'll deploy the cash, and hopefully the liquidity concerns are eased. In the same way, you can do the opposite, where central banks think that there's just too much money out there. What they actually might be doing then is they might be selling assets into the market to get cash out to drain that excess liquidity. So they use repo markets to influence that really potentially on a daily basis. One of the big newer entrants over recent years has been corporate treasurers and the treasury funding that corporations have. And number one, a lot of them have had excess cash, But more importantly, from a regulatory perspective, because these are not financial entities, regulators quite like the idea of banks and securities firms that are regulated entities in the financial space to be able to finance their assets with entities that are non-correlated in theory. So corporate treasurers and banks don't really have a lot in common necessarily. So being able to actually bring in this other sector that can provide cash into the market is very good, because if one bank's in trouble, it's likely to have a knock-on effect to other banks, even from a perception point of view. So you can see that at times when liquidity dries up, it dries up across the board. And so treasurers in that kind of corporations, they'll still have cash. And if there's a big enough participation there, that can actually help bring in more stable liquidity into the market. And so they get preferential regulatory treatment for those entities. Just want to say hello to a couple of people that have signed on. Nilesh, good to see you again. Thanks for joining me. And Lewis, good to see you back. So thanks very much for taking some time on a Saturday morning. So those are the users and participants for repo. Securities lending, it's really about, because we're talking about investors with assets that are static. They're holding on to these assets. They're sitting in custody with their broker or their custodian bank, wherever they are. And the idea is to get additional incremental rental revenue from those assets by deploying those to borrowers that want to pay them a fee for that. And this is obviously historically has been institutional investors. Now it's really focused on repo. The hottest trend on over the past few years has been retail investors getting involved with that. Robinhood is the famous example. Webull, E-Trade, Charles Schwab. There's just all kinds of entities that have happened over time. When you see them pop up in many different countries, and this is a never-ending trend. I think this has a long way to run yet. More brokers, more countries, more retail participation. That's one of the hot trends that I said 18 months ago that I still see continuing. So these are people that hold securities that are looking to generate incremental revenue. You have market makers and liquidity providers who have short-term trading needs. So they could be lenders, but in theory, they're really more often they're borrowers, again, trying to fulfill the need to be a market maker, to be able to sell securities to anyone that wants to buy at any time. Even if they're not a holder of that, they have the opportunity to borrow those securities, deliver to satisfy the buyer, and then close out the position when it's either opportunistic or profitable. You have banks who are both borrowers and lenders, and often that's to hedge their client positions. But also banks are active in terms of collateral transformations, where they're holding assets that may not get favorable regulatory treatment. And what they try to do is transform those assets into better quality assets, taking equities in their inventory and exchanging those for government bonds, which they can either just have on their balance sheet because they're required to have a certain degree of that kind of inherent cash equivalency, or to be able to use it as collateral for other collateralized obligations like the central counterparties that I mentioned, but also many bilateral exposure management positions where collateral is used. You have traders, of course, who are hedge funds, typically, and high frequency traders. There's all alternative asset managers, all kinds of different ways to describe them. Of course, the ones that are shorting the securities, they need to be able to borrow in order to actually execute the short sale in the first place, and then make the delivery obligations that the short sales create. So clearly in there. And of course, central banks, historically, if you go back sort of 15 years, they were on the periphery of this business through the last sort of dozen or 13 years, where they've become big buyers through various quantitative easing and other financing programs. They've ended up being big holders of assets themselves. And at times that's actually impacted the liquidity of the market. So what we've seen is more active participation, where they become just another lender, another source of supply to help keep the liquidity of the secondary markets operating efficiently. So those are the primary users of it. If we look at the collateral, after we do the unpaid spot for Coke, because I need to get my throat back. Hold on a sec. Okay, we're going to look at collateral again. Now, first we're going to look at the sale and repurchase of repo business. Remember, the key here is if the objective is to borrow cash, then that cash holder, the one who has the asset that's in demand, they drive the bus, right? They say, you know what, if you want my cash, you have to give me the type of collateral I want and the degree of collateral that I want, and then I'll make my cash available to you. So the excess value of securities is delivered by the cash borrower to the cash lender because that's the asset that's scarce. Just some graphs which I showed you in the last piece, which was the first of the 3 videos, the original introduction of repo. A couple of charts here. One was actually just looking at the type of assets in the US. So you see that it's overwhelmingly this big dark green spot, if you can't read the lettering, is US Treasuries. Then you get mortgage-backed securities, and then the Treasury inflation protected securities, the TIPS, are the next segment, and then it's everything else. But look, that's where banks are doing repo. That's actually what they're having to provide. And when they're doing reverse repo, where they're actually the cash lenders, it's even higher quality. They're even more discerning there, where almost 90% of the assets are really US government related assets. So you can see that there's a differentiation there. But in either case, you're talking about high quality instruments dominated by US governments in the US. If you turn to Europe, first of all, on the top chart, you can see that it's a much more diverse group. So 44% is government related. Another sort of 5 or 6% is public and subnational, so lower level governments, but government-ish or quasi-government, the supranational. So still high quality, but it's really only just over half. Big proportion of corporate bonds and other covered bonds, but look at this big chunk of equity that's used as collateral in securities lending transactions. That's just an analysis there. That's actually for repo transactions. So not even securities lending transactions. These are repo transactions, and a big chunk of that is equity repo. And of course, one of the factors in pricing and figuring out what that repo rate is, of course, the quality of your counterparty and the tenor of the transaction, but also the quality of the asset that you're taking. So if you take a lower quality asset, in theory, you should be able to charge a higher price because it's a riskier piece of collateral to hold. And this on the bottom just gives you an idea of the currency of the collateral. So you can see that while Germany and the UK and France are big chunks of it, really between them, they're less than 40% of it. And you can see that there are lower rated entities there, Italy and Spain, as an example, and reasonably big chunks. That's 16, 17% of the collateral is Italian or Spanish. Again, you'd expect people to be paying a higher rate for that. So that gives you an idea of repo collateral. And we look at securities lending. The difference with securities lending is cash is certainly part of the collateral pool, but it is not even the dominant part here. One of the problems with charts like this, where they have two scales, the left-hand scale, the right-hand scale, it's hard. You look at this kind of graph and you go, oh, they're pretty similar. Yeah, pretty much along. One or the other is ahead for a little while, but because of the scale, the reality is if you look at the purple line or whatever color you want to call it, that's actually only a little bit more than half the size of the non-cash collateral in teal. So while these two endpoints look like they're similar, they couldn't be further apart, really. So 2/3 non-cash, 1/3 cash, according to the ISLA website right now. This is the data that they show on their website right now. And then from the report that I just mentioned, this is the latest data. So data about collateral that's held in tri-party. You can see equities is 41% of it, government bonds of 49. I haven't actually compared that to recent numbers, but that strikes me as a little bit higher government bonds than we've seen for a while, and a little bit lower on equities. But don't hold me to that. I'll check on that and I'll report on that in my video next week when I do the ISLA report. And if you look at this subset of government bonds, this sort of green segment, what ISLA also provides here from the tri-party providers is the domicile of the issuers. So you can see about half of it is European, 17% is North American. So you can see Probably what's happening there is all of the US Treasuries and Canada government bonds are actually probably being used up in North America. So these are really only the assets from investors outside North America making their assets available. That's subjective, but I think that's certainly been my experience. And then this white segment here is Asian, and you find that's probably really dominated by Japanese government bonds used as collateral. Interesting compare and contrast. US very much on the repo side, dominated by government bonds. Europe, again, dominated by government bonds, but not to the same degree. In securities lending, again, a big proportion in government bonds as collateral, but really a huge chunk that is in equities. But again, bear in mind that is really 1/3 cash, 2/3 non-cash, and probably my guess is the majority of that cash collateral is to support US equity and corporate bond lending activity, and to an extent, U.S. government bond lending activity. So if you pulled out U.S. dollars or U.S. domestic assets from that pile, I think you'd find that cash figure is very much smaller. Now, again, I've talked before about how I expect that to grow as you get higher interest rates and the reinvestment opportunities grow with better interest rates. I think you'll see a shift and there'll be more activity in cash because there's an opportunity to generate incremental revenues by doing cash reinvestment. Of course, with everything within the investment world, there is no extra cash available without extra risk, or at least and maybe a layer of complexity that you need to understand and come to grips with before you can do that. Okay, so that's the collateral side of things. Fees for a repo trade, obviously they're earned by the cash lender because that's the asset that's in demand. So if you want my cash, you have to pay me for it. They get what's called the repo rate, and that repo rate applies for the period of the loan, whether that's an overnight loan, a 1 week, a 1 month, a 3 month, whatever. And that repo rate comes to that cash lender at the closing leg of the transaction. It's included in the price. So when they close out that transaction, effectively they're getting paid at that point. So the cash flow timings of the two are different. Now in securities lending, the asset that's in demand is the security that's on loan. So that's the one that gets paid by the borrower. The reason it's in inverted commas is because if you do cash collateral, this chunk here, what actually happens is the agent lender takes the cash, reinvests it in the market, gives a proportion of that money back to the borrower. It's known as a rebate rate. And in fact, by keeping it back, so the borrower isn't actually paying money to the lender directly. The lender is using that borrower's money, if you will, generating return and then giving some of it back to that entity. So the borrower is paying it. Think of them as raising cash, giving it to someone else, and then getting back the cost of funding less whatever their fee is. So hopefully that makes sense to you. If there's non-cash collateral, of course, then it is just an outright fee. The borrower and the lender agree a fee, and the borrower will pay that, and they pay it monthly in arrears. So the two entities do a reconciliation. The lender says, this is what I think you owe me. The borrower says, this is what I think I owe you. They come to an agreement, pay the money, and it's monthly in arrears. So I'll pay you this month in March for what the fees were due in February. Okay, and the other thing is that's different between the two. The repo trade, the rate stays the same. In securities lending, there's always the ability to renegotiate the loan fee based on changing supply and demand, and either side can do that, or terminate the loan or carry on the loan at the original price. So it's more flexible in that sense. Okay, so before I go to the next slide, I'll say hi to Fanny. You're always one of the regulars, so thanks again for your time to join, and appreciate you engaging with me every week. Thanks. All right, so that's it. Let's do a quick summary and a wrap up. If we look at the primary objective, repo, it's all about the cash. Somebody has it, somebody wants it, and the securities are the collateral that protect that loan against a counterparty default. Securities lending, it's obviously a collateralized loan asset, but it's actually targeted at a specific asset that a borrower wants to. The collateral is in a repo trade. It's delivered by the cash borrower, and they're the ones that have to provide the excess margin. That can be done bilaterally So the two parties just agree, I'll deliver these bonds to you directly, or it can be used by a tri-party. And the same thing with securities lending. It could be bilateral, but in securities lending, it's probably an even higher percentage that's actually done in tri-party. And of course, the securities borrower, the one that's looking for that specific asset and target, they're the ones that have to provide the excess value of collateral to that securities lender. The fees are received by the cash lender in a repo or the securities lender by the repo. And again, repo rates are fixed. Securities lending, it's negotiable or renegotiable if the two parties agree. And the difference is on a repo, the fees are paid at the closing leg as part of that transaction price. And on a securities loan, it's actually separately invoiced, reconciled, and paid monthly in arrears. And tenor for a repo trade is fixed term, short duration, and securities lending is open trades. In fact, they're so open and it's so transparent, I didn't even put the word in there. That's how open these trades are. Cancelable by either party at any point in time, okay, without penalty. Let's do a summary. Primary objective, again, repo, get cash. Securities lending, get stock or bond. The collateral side in repo, it tends to be higher quality. That's one of the key criteria. And again, if you think about it, that's probably not a surprise either, because what you want to be always looking at is who has the most liquid asset. Well, if cash is singularly the most liquid asset, they should be the ones that get the extra margin. They should be the one that gets the fees. And you know what? If you want my high quality asset, which is cash, you have to give me something else that looks like a high quality asset, like a government bond. So you can see, hopefully, that there's a little bit of equivalency and it makes sort of conceptual sense there. And of course, you can go for lower quality and adjust the price and generate incremental cash lending fees, boost your repo rate if you choose to do that. Securities lending collateral definitely is more diverse. And again, in both cases, the collateral is usually substitutable. So be aware of that. And the fees received by the provider of whoever is giving the in-demand asset. Repo, it's securities lending, it's stock and bond. Fixed rate for repo, negotiable and renegotiable for securities lending. And then the tenor, as I said, for repo is fixed term, a week, a day, overnight, a month, 3 months, 37 days, whatever you like. It's actually a fixed term. Again, there's open trades. There's always exceptions to everything I say. So what I always talk about is just the either the overwhelming majority, or in some cases it is absolute. Anything is negotiable. So repo, fixed term, securities lending, open trades, always recallable at the very latest by a normal settlement cycle for the asset that has been loaned out. Okay, so very flexible from that point of view. And that enables asset managers who own the assets to continue to implement whatever their investment trading strategy is without fear of not being able to deliver because they have loaned out a security that they have subsequently sold. Okay, so those are the questions. And that, my friends, is a wrap. As I said, next week we'll be talking about the Islam market report. There it is there. I will make certain there's a link in the program to be able to find it. That's it for me. I hope you found that whirlwind tour of a comparison of repo and securities lending. I hope you found it helpful. Thanks very much for taking the time with me, either live or on replay. Have a great Saturday. Have a great weekend. Have a great week. And I look forward to seeing you next weekend.